Good morning, everybody. Welcome to Tuesday, and welcome to October. Happy October, everybody. It's time for our Tuesday weekly webinar. So I'm going to break down the format for you. We're going to talk about some Ed Slott updates, updates from the Ed Slott Group. Ed and his team send us very timely and good information about IRA distribution issues, anything from RMDs, 401k distributions, all that. You've heard it before. Maybe if you've joined us for these webinars before, then we're going to talk about the market. So we're going to do a monthly recap this week, since September just ended last week, and we'll talk about some analyst reports, and then we're going to move on to our financial 15 or our financial planning topic this week, which is part of a 4-part series, and that is common retirement mistakes. So that is common retirement mistakes. That's a 4-part series, and this week we're going to talk about medical costs after Medicare. So what this topic really is things that other advisors or even your own planner, your own planning, something you might be missing in your own financial planning, either whether you're working with a financial advisor or not. But this is what I've seen as I'm reviewing plans and talking to other advisors around the country. These are things that are commonly missed. And last week we talked about expenses, what your true cost of retirement expenses are. So if you haven't seen that video, you can go back and look at that video. And then this week we're going to talk about, as I said, medical expenses after Medicare. Not next week, because there is no webinar next week. Next week follows a market holiday, so I don't do webinars after a market holiday because just honestly, it's very, very difficult for me to get the information together, the market information together after it's been closed the previous day. So the following week, after next week, we're going to talk about the dreaded IRMA charges during retirement. If you're unfortunate enough to deal with IRMA for a long period of time, what the effect could be on your retirement. And part 4 will be taxes. So again, part 2 today will be medical after Medicare. And if you're just joining us, if this is your first time on this weekly webinar, I've laid out the schedule for you. However, in the description, it is indexed. So if you're watching us on YouTube or listening to us on YouTube, it is indexed in the description. But then we also do a separate Financial 15 playlist for these Financial 15 topics, because if I'm being honest, I tend to talk longer than 15 minutes. So we've broken it down to shorter segments of time for you. So it's a little easier to digest, and you'll find these in individual playlists on our YouTube channel. So I encourage you to go to our YouTube channel, and if you haven't already, hit the subscribe, like, and notification button, because every time we put up one of these videos, you're notified, and then you can figure out when you want to watch it and watch it over and over and over again. And if you like the video, please give me a like. I appreciate that. Okay, so let's jump into it. So in our Ed Slott updates, I'm going to share with you, there was a really good one today that I think my friend Andy Ives did, and it was 10 common questions that they get from financial advisors and people who write in. But Andy listed these 12 common questions, and it, first of all, it would take a long time to discuss. Second of all, there weren't solutions for each question, or he couldn't get into detail. But what it is for me is a great list of topics for webinars, really probably for 2024, because I have a lot of them already for 2023. So thank you, Andy, for keeping topics fresh for us. So today's Slott report mailbag, and that's, of course, people writing in and asking questions, is written by Sarah Brenner. So I'm going to share my screen here with you. And this one talks about net unrealized appreciation, or NUA, and see-through trust, today's Slott report mailbag. Now, these are two pretty sophisticated topics, so they're not going to apply to a lot of people. But I am re-listening. I read Ed's retirement planning time bomb. I think that's the right title, many years ago. And then I read his updated version of that book when it first came out. It feels like a year ago, but it was, how it goes. It was probably 2 years ago. I hope it wasn't more than that. But I'm listening to that again on audiobook. And I am reminded of the need to review trusts that are designated beneficiaries and IRA plans. because most of them are unnecessary and outdated from the Secure Act. The change in not even necessarily Secure 2.0, but Secure 1.0 really negated all the benefits of having a trust designated as a beneficiary. So, and for an IRA or a retirement plan. So, if you have a trust as a beneficiary, let's take a look at that. Reach out to us at questions. Wait, let me give my fancy little questions at attleboroughwealth.com. That's questions at attleboroughwealth.com. Let's talk about it. And it's definitely something that needs to be reviewed. If you have a trust named as a beneficiary of your IRA or retirement account. So let me go back and we'll read through this questions and mailbag. So good afternoon. This person writes to Sarah, good afternoon. I'm looking for some net unrealized appreciation help, please. If someone does a rollover of company stock to an IRA, can she undo that rollover and then do an NUA transaction? And this person's name is Alan. So Sarah writes, hi, Alan. The NUA strategy can be a good option when there is highly appreciated employer stock in an employer plan. The stock can be distributed in kind, and any appreciation can be taxed at long-term capital gains rates. Among other requirements, you must have a distribution of the stock in kind from the plan to you. It cannot be rolled over to an IRA. Unfortunately, an IRA rollover is irrevocable. So if this has already happened, then there is no way to reverse a transaction and use the NUA strategy. So NUA, net unrealized appreciation, NUA, net unrealized appreciation, can save an individual a good amount of tax money, sometimes a lot of tax money. Because as Sarah said, if you distribute that company stock, it has to be distributed into a non-IRA account. You pay tax on the original cost of that. You pay ordinary income tax on the original cost of that distribution. It's not a rollover to an IRA. It's actually you distribute that money out to a non-IRA account, and you pay tax, ordinary income tax, on the basis, the amount that stock cost you. But any gain is treated as long-term capital gains. Now, I've seen a lot of mistakes around this because there are rules. The rest of the account has to be fully distributed. That can mean rollover by the end of the calendar year. So it can get really tight trying to do it by the end of the year. If you come into December or something like that, so that can be challenging. But some people think that you have to hold the stock for a long period of time to realize those long-term capital gains. That's not what the IRS says. If you want to sell it right away, you can sell it right away and you realize long-term capital gains on the declining growth. So if you think about it, I'm just making this up, but if you work for Apple, as an example, you work for Apple and you have some Apple stock in your IRA, in your 401k, and you say, I want to take advantage of this NUA, and say you paid $100,000 for that stock, and now it's worth $1 million. Well, if you rolled it to an IRA, first of all, it'd have to be liquidated to roll it to an IRA because you can't transfer stock in kind from a 401k to an IRA. Not that I know of or I've ever heard of. But you must liquidate it and transfer it to an IRA. Any distribution, of course, in that IRA will be treated as ordinary income tax. Now, if you take a NUA, net unrealized appreciation, distribution to your non-IRA account, well, you pay ordinary income tax on that $100,000, but you pay long-term capital gains tax on that $900,000. So that can be really beneficial. But a lot of people get really caught up in NUA because it's kind of fancy and sophisticated, but a lot of times it doesn't make sense. Sometimes it makes great sense. Many times it doesn't make sense. So it's a good opportunity that you should research. It has a lot of requirements, so you definitely have to work with a qualified advisor. I can't tell you how many times I've seen people mess this up and come to us and say, how do I fix it? And there's no fix. So here's another question. Are you able to have a testamentary trust or a trust under will still have it qualified as a see-through trust, which would allow the 10-year rule to be used? The testamentary trust outlined in the will does appear to meet the see-through trust requirements. Thank you, Melanie. So here's Sarah's answer. Sarah's an attorney, by the way, so it's helpful to have Sarah on the team. Hi, Melanie. Yes, a testamentary trust can qualify as a see-through trust, which would allow the use of a 10-year rule of the 10-year rule distributions from an inherited IRA. To be a see-through trust, the following requirements must be met. The trust must be valid under state law, or would be, but for the fact that there is no corpus. The trust must be, now you can just tell by that Sarah's an attorney, right? The trust must be irrevocable or becomes irrevocable upon the death of the account owner. Beneficiaries of the trust who are beneficiaries with respect to the trust's interest in the retirement plan must be identifiable, so they must be named. The trustees, and they have to be people. It can't, to the best of my knowledge, and I'm 99% sure I'm right, it can't be a charity or something like that. The trustee of the trust must provide a copy of the trust or a list of the trust beneficiaries and their entitlements to the plan trustee, custodian, or administrator no later than October 31st of the year following the year of the account owner's death. So I know that's confusing, and this all just comes back to, folks, get help from a qualified planner or advisor on these issues, and don't mess around with them. And if you do, I'm just going to say it again, if you do have a trust name as a beneficiary, it is time. Is past time, but it is time to review those designations, and you are likely going to want to change that because it just doesn't make sense after the changes of the Secure Act. Okay, moving on. Now we're going to talk about the markets. So if you didn't know, September wasn't a great month. I'm going to talk about this a bit, but historically September isn't a great month, but this was an exceptionally bad month for the markets. So I'm going to read some of our analyst reports. So a Fed that may keep rates higher for longer, political tension rising, higher oil prices, and a stretched consumer all contributed to lower stock and bond prices in September. Historically, September is the worst month of the year for the stock market, with the S&P 500 averaging a 1.1% drop during the month, dating all the way back to 1928. Unfortunately, this September lived up to that reputation, with the S&P 500 falling roughly 4%, as I said. Inflation readings remain relatively steady, but economic measures continued to point to stronger than expected growth. So that's not, let me just pause there for a second. That's not really great for the Fed outlook, because when you read things, and we're hearing this all over the place. So what they just said was inflation has remained relatively steady, but economic measures continued to point to stronger than expected growth. So that tells me that the Fed is probably going to keep raising rates because they want they really need the economic growth to slow as well. So they go on to talk about a dot plot. So the dot plot, it shows where, I guess I think this just shows it. The dot plot released after the meeting, they're talking about the central bank's meeting, released after the meeting, showed that the central bank now expects greater economic growth and that higher rates will be required for longer. This added to investor concerns and already This added to investor concerns that already included rising tensions with China that further escalated after a ban was imposed on Apple devices for government employees and higher oil prices that could add to inflationary pressures and consumer stress. So we talked about that throughout the month. But that continues, of course. Additionally, bond prices fell, with the 10-year yield pushing over 4.6% during the month for the first time before the 2008 financial crisis. So let me repeat that again because it's important. Bond prices fell, so as interest rates go up, bond values come down, with the 10-year Treasury yield pushing over 4.6% during the month for the first time since before the 2008 financial crisis. That's an important point. Given the headwinds facing investors, stocks held up quite well, and a slow, controlled decline during the month was a healthy development that improved stretch valuations in a number of sectors. So what that means is that even though September felt terrible, a 4% drop, given all the things that we heard, this analyst feels that it wasn't as bad as it could have been. So let's look at last week. So last week, the Dow Jones Industrial Average dropped 1.34%. The S&P 500, 0.71, down 0.71. The NASDAQ was up slightly, 0.07. The MSCI World Index, it was down 1.41. And everything was down low single digits. So the highest drop, right, the deepest drop was 1.42%. And the best range, or the best return, was the NASDAQ at 0.07%. The bond market dropped again, just about 1%, 0.96%. So bonds took a huge hit last year, and most people weren't expecting it. You've heard me say this over and over again. The bonds are supposed to zig when the market zags, and they both zig and zag together. So we were very fortunate in our practice here to avoid most of that. But the Barclays U.S. Aggregate Bond Index, which is where most people have their funds historically, was down another 1%, 0.96%. In fact, the short-term bonds, 1 to 3 years, was up slightly, 0.09, and the 6-month Treasury went up to 5.54%, up slightly from a week before. So interest rates are still going up. And the 10-year Treasury, as we said earlier, was at 4.57%, up from 4.43% the week before. Back on 12/31/2022, the 10-year Treasury was at 3.87. And I'd have to go back and look at my notes, but it wasn't that long ago when it was in the, when it was less than 1. So BlackRock's iShares division in particular, they write, interest rates are likely to remain higher for longer on the heels of better than expected growth. Fixed income, that means bonds. I'm reaching for my pen. Hold on one second. I need my pen to mark up the whiteboard in a moment. Okay. So let me go back to the beginning. So BlackRock writes, interest rates are likely to remain higher for longer on the heels of better than expected growth. So I talked about that just a few minutes ago. And then they write, fixed income remains our highest conviction trade. Fixed income means bonds. So when you hear equities, it means stocks. When you hear fixed income, it means bonds. Fixed income remains our highest conviction rate, although we see select opportunities in high quality equities, so equities equals stock. So although we see select opportunity in high quality stocks, I'm translating here a little bit, such as energy and industrials, we see potential upside in countries like Japan, Mexico, and India, which benefit from structural global events like deglobalization and nearshoring. So I pause on these words sometimes because we have a pretty vast audience. We have some people who are, high-level executives who are very good at their jobs who say, I don't know anything about or very, very little about my investments and planning. And I'm really not, I want to kind of hear what's going on, but I'm not here to be a financial planner or an economist or anything like that. And then we have people who watch this or attend this webinar all the time who are very, very astute. One fellow is a PhD in, I think it's economics, but he's going to tell me if he's on here. He's going to chat and tell me. Okay, so that was BlackRock. Goldman Sachs writes, government shutdown since 1980. So everybody was talking about government shutdowns. I was down at the, we did a charity bike ride from Cherry Hill, New Jersey to Ocean City, New Jersey. That doesn't sound as impressive as Center City, the one I do it in the early summer, which is Center City, Philadelphia to Atlantic City. But the one from Cherry Hill, New Jersey to Ocean City, New Jersey is about 10 miles longer. And that was for MS, to benefit MS research. But even our group, we were talking about government shutdowns. I had a client in last week who's planning a trip to national parks, and they were wondering if it was going to be able to happen because of government shutdowns. So a lot of the discussion is, well, what happens if the government shutdowns? We don't trust these folks in Washington to be able to get the job done. Thank you, Kathy. Good morning. We don't trust these folks in Washington to get the job done. So how do we know that we're not going to have this shutdown? And what would that mean for the market? So I like this piece from Goldman Sachs. They had a chart to go along with it, but it really didn't add much value in my opinion. But they wrote the government shutdowns since 1980 have lasted on median 4 days, but a shutdown in 2023 may last 2 to 3 weeks because the people can't play well together, right? We expect annualized growth by decline by 0.2 percentage points for each week that a shutdown lasts. So 0.2 percentage points. So that's a decline of 0.2% for each week that a shutdown lasts, but believe those losses can be recovered in subsequent months, in part due to back paying government salaries. Historical market impacts have been relatively muted since 1980. The S&P 500 has delivered a median return of 0.75% during government shutdowns. So I'm reading that as Goldman Sachs saying, don't worry too much about it. If there is this prolonged government shutdown, the markets seem to recover historically. Now, there are other factors that we have to pay attention to. We have, still a strong economy fighting against kind of stubborn inflation, and the Fed, who is persistent on rising interest rates. So could that put a little wrench in what's happened in the past? Of course it could. But Goldman Sachs is saying, don't worry about it too much. So I like that message. Okay, we're going to move on now to our Financial 15. And this was an interesting exercise for me. So I listed these things out, a few weeks ago, and I developed them just to give you kind of a behind the scenes. Thank you, Doug. Doug said hello and said, I can hear just fine. I appreciate that. So just give you a kind of a behind the scenes. I keep a rolling list now of webinar topics, and they all come from you folks, honestly, because I'll be meeting with a person or talking to the person on the phone or on Zoom, and they'll have a question, and I'll say, well, that's a really good question, and I'll answer the question, or I'll get an answer to the question, and I'll say, in fact, it's a really good webinar topic. So I'll start listing those. Sometimes they come from readings and things I'm reading, like the Slott report today. I think I shared with you that I'm working through David McKnight's books again. I recently read The Power Zero, Tax-Free Income for Life, and Look Before You LERP, and then I shifted to Ed's book on audio because I had a credit for the month and I want to use it. But I'm going back to read Dave's Volatility Shield book, which is a book I haven't read for years. And he let me know this week that he's got a new one coming out. So that's exciting. But we're going to move into our Financial 15. And this topic, what was I saying? So I went through when I came up with this topic, the more common retirement mistakes, because we had done it before in March, as you heard me. It was 4-part. So we have expenses, medical expenses after Medicare, IRMA, and then of course taxes. These really came from discovery items during financial plans with people, but this one surprised me the most as I got into it. The medical expenses after Medicare, because things have changed over the past couple of years. Let me share my screen with you. So this is what we're looking at. So this is our more, and I'm gonna put this down, and so I can write on this just like I always do. So if you're just joining us, if you're either index forward on the weekly webinar, or if you've just joined us from the playlist of the Financial 15, this is the Financial 15 or financial planning portion of our weekly webinar. So what you just missed, if you're just joining us, is about 10 or 15 minutes of updates from the Ed Slott Elite Advisor Group. So that's updates on IRA withdrawals, RMD issues, things like that. All beneficial things, I believe, for your retirement plan. And then we talked about the markets. We talked about what happened in September and what some analysts thought. And this is the last section, which is the Financial 15. And this is part 2 of a 4-part series. If you missed part 1, you can go back and listen to it. But most importantly, if you want to keep up on our videos, hit the subscribe, like, and notification buttons so you never miss one. Okay, so this part 2, medical expenses after Medicare, what your planner or financial advisor might be missing or wrong about. Now, of course, not us, but I see this with other planners and advisors, and this is not even a derogatory statement. It's just saying these folks, it's just like the tax planning. People ask me all the time, Mark, these tax plans that you're talking about, I've never heard this before. Roth conversions, getting to zero, getting close, minimize your taxes, showing millions of dollars in many cases of savings over a person's lifetime. Why haven't I heard this before? Well, unfortunately, and I was there, folks, you've heard my story. At Payne Weber, at UBS, at Wachovia, at Wells Fargo, we were never taught these things. We were taught how to bring money in, how to bring clients in. We were taught that very, very well. Almost all the training is based around that. It's not about effective financial plans and tax-efficient planning. So that's why you don't hear these things for the most part. It also could be a fee issue, but we won't get into that. So what your financial planner or financial advisor might be missing. So let's address this one first, and this is really what we're talking about. These are things that are not on most people's radar. So if we were in a live class, I'd say, who here is over 65 and receiving Medicare benefits? And people would raise their hand, and then I'd say, who's paying costs over the cost of Medicare? And almost everybody would raise their hand. If I asked the question of a 60-year-old, of a 55-year-old, of a 50-year-old, there would be less and less people in that range. So a 60-year-old may know that there's added costs of medical expenses after Medicare. Probably not. Maybe if they're starting to attend webinars and read books and things like that, hopefully they're hearing the message. I will tell you again, though, that there are plenty of financial advisors out there that are surprised when they hear this message from me. If I go into, so that's a 60-year-old. If I'm a 55-year-old and I'm planning for starting to plan for retirement, this is a foreign concept to me. Well, wait a minute. I'm going to have to pay medical costs in 10 years if I retire in 10 years and start collecting Medicare benefits, or even if I'm not retired, right? And I start collecting Medicare benefits. And a 50-year-old, folks, they're not even seeing this. So what's the cost of that? Well, it's a little harder to identify today. It used to be, and I scoured my bookmarks. We used to be able to go onto the Medicare's website, and they would give us the average cost of a healthy individual over 65. So this has increased over the years, and it started at about $5,000 a year, but we're at about $5,800 to $6,000 a year of out-of-pocket cost per individual. So let's just use this number for discussion. You're a married couple, $12,000 a year that you're not even considering. Maybe. That's a lot of money, folks. Now, the other side of that is Medicare would tell us to inflate that at 5%. So with inflation rates the way they are today, that may not be as shocking, but I have to tell you, when we talked about this 3 years ago, people would get 5%. Right now, it's like it's 5%. It's kind of less than what the groceries are costing me as far as inflation, but that's still a huge number, and it's $12,000 a year. So now I say that it's not as simple because there are some different rules now, and there are some different things that are affecting this number, and it makes it, of course, more challenging. It's funny, Ed Slott. I'm just reminded. When I talk to him in person, or I'm attending one of his training classes, or now just reading his, listening to his book, he's a funny individual. And some of the comments about how every time there's a new tax law change, it makes things more difficult, and just the sly way he puts little digs into Congress is quite funny. So if you haven't read Ed's book, you should. The Retirement Savings Time Bomb, and the new one is called, I think, the New Retirement Savings Time Bomb. So Ed's a very, very funny individual. And if you can still find him on PBS, and you can find some recordings online. You can hear him on our website, outofourwealth.com. But it's definitely entertaining. My point being is that he's absolutely right. Every time a new piece of legislation comes down, the Secure Act, the Tax Cuts and Jobs Act eliminated stretch IRAs. That was a bad deal for folks inheriting a retirement plan. The Secure Act had far-reaching implications. Secure 2.0 Secure Act made it even more difficult for folks who inherited IRAs. It had some benefits to retirees as far as increasing RMD ages. There are certainly some pros, but it makes it much, much more complicated. So whether they're benefits or drawbacks, the complication level increases dramatically every time there's a new piece of legislation. And that is the same for the Inflation Reduction Act. So the Inflation Reduction Act came in. It established or changed some caps on out-of-pocket Medicare expenses. And from what I see, it's eliminated the ability for Medicare to say, okay, this is the average cost of care for a person over 65, a healthy person over 65. Now, I say healthy person over 65 because there's pluses. So if you are a diabetic, for example, this costs more. If you're a diabetic and you have heart issues, your average cost is going to be more. So you should pay attention to these things, but it's very, very difficult to be 100% accurate. But what you want to make sure is that I hate to use the word budget, but you're setting aside some funds, whether it's $5,800 a year or $6,000 a year adjusted for inflation, just in case you need these costs during your lifetime. I'm talking about just so I wasn't clear about this. So what are these out-of-pocket costs? So let's go through, and I think we can see this here. This is a list I pulled from. I think these all came from Health and Human Services. Let's see. But here's an example, and I'm not going to go through each one of these. I promise. But here are the 2023 Medicare out-of-pocket costs at a glance. So we have potential additional premiums for Part A, right? Deductible, coinsurance. We've got these coinsurance payments for hospital stays. So $400 a day, $800 a day. Part B, medical insurance. This is the current premium. Could be higher depending on income, and we're going to talk about this month or next time we get together. This is referred to as IRMA, income related monthly adjustment amount. Deductibles. And then we get into Medicare Advantage plans. So these range quite a bit, and this is where the out-of-pocket maximums come in. But if you've ever shopped, many of you have shopped Medicare Advantage plans. There's a lot of different costs involved in that. So the premium varies by plan. Then we have Part D. So that's drugs, right? So that's pretty simple. D equals drugs. But we've got, then we have coinsurance on that. Out-of-pocket maximum for catastrophic coverage kicks in when you hit $7,400 of out-of-pocket costs. So there's just a lot of things that can add up. It's basically deductibles, co-pays, things like that. They're your out-of-pocket costs that we have to be concerned about. And why is that important? Well, folks, it's important because if you're not considering it and it's $12,000 a year, it's just like, in class we talk about taxation of your Social Security. If you're planning on receiving $30,000 a year in Social Security and suddenly you've got to pay $5,000 of tax on that Social Security, then you only have $25,000 to spend out of that Social Security, right? Otherwise, you have to make up the difference by taking it from your IRA or your other accounts, and you got tax on that. So it's the same thing. If you're planning on, let's say, spending $70,000 a year, and then you have to reduce that spending by 12 for medical expenses that you're not considering, and then you got to also reduce it by let's call it 6 for Social Security tax that you're not spending. Well, that's a lot less money you have to spend, right? So what's that take us down to? Is that $52,000? So I think that takes us down to $52,000. And if that math isn't right, because I didn't do it beforehand, if that math isn't right, then I am going to you're going to see a new video about this before we send it to recording. But yeah, that could change your standard of living, right? And it's just by not having these things planned on in advance. So it's very, very important to plan on these things in advance and have them part of your plan. And when I tell you that I see this missed all the time, I am not exaggerating. This is an area that people say, oh, you know what? I wasn't thinking about that. And it's not just you folks. It's not just you folks who are the retirees. It's also, unfortunately, the financial planners and financial professionals out there, because they are primarily focused on investments and investment returns. I don't want to take away any value of a good investment strategy and good investment returns. They're very, very important. But when you're talking about $18,000 a year, boy, you got to really soar with your investments to make up an after-tax $18,000 a year. All right, let's see if there's something else that we should be covering here. So what I pulled here, and you can see my references here. healthandhumanservices.gov. You can go through and read some of these on your own if you'd like. This is not proprietary or secret information that only financial planners have. You can pull this up at any time. So what's the moral of the story today? Moral story for this section is be careful and make sure you're planning for medical expenses after Medicare. I am not talking about long-term care. This is not a long-term care discussion. This is just out-of-pocket expenses that Medicare does not cover. Medicare does not cover. So the average, and I'll just put it here. This reads in 2023, right here, the weighted average of out-of-pocket limit. I don't like that. See, this is the difference between what Medicare used to give us and what they give us now. But in 2023, the weighted average out-of-pocket limit for Medicare Advantage enrollees is $4,835 for in-network services and $8,659 for in-network and out-of-network services combined. For enrollees in HMOs, the average out-of-pocket in-network limit is $4,000. So these are limits, but the average cost, you can plan for $5,800 to about $6,000, in my opinion, from what I've seen, with an inflation rate of 5%. If you're not considering that, you're missing, and this is per individual. So if you're a married couple, that is, of course, times 2. So that equals $10,000 to $12,000 a year that you certainly better be considering in your retirement plan, because this is certainly just going to happen. You can argue with me all day long about the need for long-term care. I think that's something that you should plan for. More than 70% of retirees are likely to need long-term care during their lifetime, and it can be devastatingly expensive. But everybody's going to need medical care, medical upkeep. You just can't avoid it. And these are the average costs that Medicare tells us. Now, I've had people sitting at the table that say, I don't spend I remember one individual in particular. My father just passed at 92 years old, and he never spent more than the cost of his Advantage plan or additional coverage, Medigap plans, whatever works for you. And he said he never spent more than that. So this is it's not something that's going to happen to me. Well, folks, that is I will call it an irresponsible position to take, because wouldn't it be better to set aside that $5,800 or $6,000 a year per individual just in case you need it and then not need it? Wouldn't that be better than having to adjust your standard of living for something that you just didn't plan for or just didn't agree? This information comes from Medicare. It's not as clear as it used to be. I'll give you that. But Medicare has all the data. I'm not going to argue with the information that Medicare gives us. They're the largest medical provider in the country. Why shouldn't we listen to what their average costs are? So I hope that's helpful today. That's just part 2. Again, part 3 in 2 weeks. We're going to talk about Irma, the dreaded Aunt Irma. Everybody knows about Uncle Sam, but most people don't learn about their Aunt Irma until they get a bill in the mail, right? And an assessment in the mail. And then the following week, we're going to talk about taxes. And there's a lot to talk about with that one. But that's the Financial 15 for the week, and that is our weekly webinar for the week. If you have questions, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. And if you want to find out more information about Attleboro Wealth, you can go to attleborowealth.com and peruse our website. You can download tax planning documents from there. We have a really nice tax planning tax planning white paper as well. So if you have any questions when you go on the website, you can reach out to us. If you want to schedule time, you can also go to questions@attleborowealth.com. If I didn't say that before, I hope this was beneficial. I hope you folks all have a great week. Remember, no webinar next week. It follows a market holiday. If you're joining us tonight on the Change Your World of Retirement Planning class, I am looking forward to seeing you. Otherwise, have a great week. Thank you.